Technology. 10. Blockchain and cryptocurrency. Redefining money and transactions. What is blockchain? Blockchain is a decentralized and distributed digital ledger that records transactions across multiple computers in a secure and transparent manner. It operates on a peer-to-peer network, where participants called nodes maintain a copy of the entire blockchain and work together to validate and verify transactions. Each transaction is grouped into a block, which is linked to the previous block, forming a chain of blocks. Blockchain technology relies on cryptographic algorithms to ensure the integrity and security of the data stored on the blockchain. It eliminates the need for a central authority or intermediary to facilitate transactions, as the consensus among network participants governs the validity of transactions. Cryptocurrency definition. Cryptocurrency is a digital or virtual form of currency that uses cryptography for secure transactions and operates independently of a central bank. It is based on blockchain technology and leverages encryption techniques to secure financial transactions, control the creation of new units, and verify the transfer of assets. Cryptocurrencies use decentralized networks and consensus mechanisms to maintain transaction records and prevent double spending. Unlike traditional fiat currencies, cryptocurrencies are not issued or regulated by any central authority, such as a government or central bank. They offer the potential for secure, fast, and low-cost transactions, as well as the ability to store and transfer value digitally. Bitcoin. Bitcoin is the first and most well-known cryptocurrency, introduced in 2009 by an anonymous person or group of people known as Satoshi Nakamoto. Bitcoin operates on a decentralized peer-to-peer network, using blockchain technology to record and validate transactions. It was designed to be a digital currency that enables direct peer-to-peer transactions without the need for intermediaries. Bitcoin relies on a consensus mechanism called proof of work, POW, where miners compete to solve complex mathematical problems to validate transactions and add them to the blockchain. Bitcoin's decentralized nature, limited supply, and increasing adoption have contributed to its emergence as a prominent digital currency and a store of value. Decentralization. Blockchain and cryptocurrency technologies aim to decentralize financial systems by eliminating the need for intermediaries, such as banks, in conducting transactions. Traditional financial systems rely on centralized institutions to facilitate and verify transactions. In contrast, blockchain technology enables direct peer-to-peer transactions without the need for intermediaries. By decentralizing transactions, blockchain technology provides transparency, security, and the potential for lower transaction costs. It shifts the control and verification of transactions to a distributed network of participants, promoting trust and reducing the risk of fraud or manipulation. Decentralization in blockchain and cryptocurrency systems also allows for greater financial inclusivity, as individuals without access to traditional banking services can participate in the global economy. Transaction validation. In a blockchain network, transactions are validated by network participants called miners who solve complex mathematical problems to verify and add transactions to the blockchain. When a user initiates a transaction, it is broadcasted to the network. Miners then compete to solve a mathematical puzzle associated with the transaction. The first miner to solve the puzzle and validate the transaction adds it to a new block in the blockchain. Other miners in the network verify the correctness of the solution and the transaction details before accepting it as valid. This consensus mechanism ensures that only valid transactions are added to the blockchain and prevents double spending, where the same asset is spent multiple times. The transaction validation process in blockchain networks provides security, transparency, and immutability of transaction records. Immutability. Once a transaction is recorded on the blockchain, it is nearly impossible to alter or tamper with the transaction history, ensuring the integrity and security of the data. Each block in the blockchain contains a cryptographic hash, a unique digital fingerprint, that is generated based on the block's data. The hash of each block is also included in the subsequent block, creating a chain of hashes that links all the blocks together. Changing the data in a block would require recalculating the hash of that block and all subsequent blocks, which is computationally infeasible due to the distributed nature of the blockchain network and the consensus mechanisms in place. This immutability makes blockchain technology suitable for applications that require tamper-proof and auditable transaction records, such as financial transactions, supply chain management, and identity verification. Smart contracts. Smart contracts are self-executing contracts with predefined rules and conditions encoded into the blockchain, automatically executing actions when the conditions are met. They operate on the principle of if-then statements, where the terms of the contract are written in code and enforced by the blockchain network. Smart contracts eliminate the need for intermediaries or trusted third parties to enforce agreements, as the execution of the contract is automated and verified by the network. Ethereum, a blockchain platform, introduced the concept of smart contracts and provides a programming language for creating and executing them. Smart contracts have applications beyond financial transactions and can be used for various purposes, including decentralized applications, supply chain management, and decentralized finance, DeFi. Ethereum is a blockchain platform that introduced the concept of smart contracts, enabling the development of decentralized applications, dApps, and other cryptocurrencies. It provides a programmable blockchain platform where developers can build and deploy smart contracts and decentralized applications. Ethereum utilizes its cryptocurrency called Ether, ETH, as a means of value exchange within the network. Unlike Bitcoin, which primarily serves as digital currency, Ethereum focuses on enabling a broader range of decentralized applications beyond simple financial transactions. Ethereum's programmability and flexibility have contributed to its popularity and widespread adoption in the blockchain space, facilitating the development of innovative applications and projects. Tokenization. Tokenization is the process of representing real-world assets, such as property or shares, as digital tokens on the blockchain, facilitating fractional ownership and easier transferability. Through tokenization, assets are divided into digital tokens that represent ownership rights or value. These tokens can be transferred, traded, or exchanged on the blockchain, providing liquidity and accessibility to assets that were traditionally illiquid or restricted. Tokenization brings several benefits, including increased transparency, improved liquidity, reduced transaction costs, and the potential for fractional ownership. It enables individuals to own a fraction of high-value assets, such as real estate or artworks, and participate in investment opportunities that were previously inaccessible. Tokenization also opens up new avenues for crowdfunding and peer-to-peer transactions, allowing individuals to invest in projects or assets with greater ease and efficiency. By leveraging blockchain technology for tokenization, industries such as real estate, finance, and art can undergo transformative changes, unlocking new possibilities for asset ownership, trading, and investment. Initial coin offering, ICO. An ICO is a fundraising method where a company or project sells digital tokens to investors in exchange for cryptocurrency, typically used to fund the development of a new blockchain-based project. During an ICO, the project team issues tokens that represent a stake or utility in the project. Investors can purchase these tokens using cryptocurrencies like Bitcoin or Ethereum. ICOs gained popularity as a way for blockchain projects to raise capital and distribute their tokens to a wide range of investors. However, ICOs also raised concerns due to regulatory uncertainties and the potential for fraudulent activities. As a result, regulatory authorities in various jurisdictions have implemented guidelines and regulations to protect investors and ensure compliance with securities laws. Security and privacy. Blockchain technology provides secure and private transactions by encrypting and protecting data using cryptographic algorithms. Each transaction recorded on the blockchain is secured through cryptography, making it difficult for unauthorized parties to tamper with or alter the data. The use of public-private key pairs enables secure authentication and digital signatures, ensuring that only authorized participants can initiate transactions. Additionally, the distributed nature of the blockchain network adds an extra layer of security, as the consensus mechanism requires the agreement of multiple network participants before a transaction is considered valid. However, it is important to note that while blockchain technology provides strong security measures, the implementation and management of blockchain systems must still consider potential vulnerabilities, such as key management and network security. Permissioned and permissionless blockchains. Blockchain networks can be classified as permissioned or permissionless based on the level of access and control required to participate in the network. Permissioned blockchains, also known as private blockchains, restrict access to the network and require participants to have permission or authorization to join. These blockchains are typically used in enterprise settings, where trust and privacy among known participants are prioritized. Permissionless blockchains, on the other hand, are open to anyone who wants to participate, and no central authority controls access. Examples of permissionless blockchains include Bitcoin and Ethereum. Permissioned blockchains offer greater control and privacy, while permissionless blockchains provide openness and inclusivity. Consensus mechanisms. Consensus mechanisms are protocols used in blockchain networks to achieve agreement on the state of the blockchain, such as proof of work, POW, and proof of stake, POS. In a POW consensus mechanism, miners compete to solve computationally intensive puzzles, with the first miner to solve the puzzle gaining the right to validate and add a block to the blockchain. This process requires significant computational power and energy consumption. POS, on the other hand, selects validators to create new blocks based on their stake or ownership of cryptocurrency within the network. Validators are chosen in a deterministic way, reducing the need for high energy consumption. There are also other consensus mechanisms, such as delegated proof of stake, DPoS, and practical Byzantine fault tolerance, PBFT, each with its own approach to achieving consensus. Consensus mechanisms ensure that all participants in the blockchain network agree on the validity of transactions and maintain the integrity of the blockchain. Scalability challenges. Blockchain technology faces scalability challenges in terms of transaction throughput and network capacity, which need to be addressed for wider adoption. As more transactions are added to the blockchain, the size of the blockchain grows, making it slower and more resource-intensive to validate and process transactions. Scaling solutions are being developed to address these challenges, including off-chain solutions such as payment channels and Layer 2 protocols, as well as on-chain approaches like sharding and consensus algorithm optimizations. These solutions aim to increase the transaction capacity and speed of blockchain networks while maintaining the security and decentralization that are core principles of blockchain technology. Cryptocurrency exchanges. Cryptocurrency exchanges are platforms where users can buy, sell, and trade cryptocurrencies with other users or fiat currencies. These exchanges provide a marketplace where participants can exchange different cryptocurrencies based on current market prices. Cryptocurrency exchanges play a vital role in the cryptocurrency ecosystem, as they provide liquidity and facilitate price discovery for various digital assets. Users can create accounts on these exchanges, deposit funds, and execute buy or sell orders based on their trading preferences. Some exchanges offer advanced trading features, including margin trading and derivatives. However, it is important for users to choose reputable and regulated exchanges to ensure the security of their funds and comply with regulatory requirements. Blockchain and supply chain. Blockchain technology is being explored for supply chain management, enabling transparent and traceable tracking of goods from origin to destination. By recording transactions and product-related information on a blockchain, supply chain participants can verify the authenticity, quality, and movement of goods throughout the supply chain. This improves visibility, reduces the risk of counterfeit products, and enhances supply chain efficiency. Blockchain-based supply chain solutions enable real-time monitoring of inventory, automated verification of certifications or compliance, and streamlined processes for logistics and payments. Implementing blockchain in supply chain management can lead to cost savings, increased trust among participants, and improved customer satisfaction by ensuring product authenticity and traceability. Cross-border payments. Blockchain-based cryptocurrencies can facilitate faster and cheaper cross-border transactions compared to traditional banking systems. Cryptocurrencies remove the need for intermediaries and can enable direct peer-to-peer transactions across borders. By leveraging blockchain technology, cross-border payments can bypass the traditional correspondent banking network, reducing the time, cost, and complexity associated with international transfers. Cryptocurrencies can provide a decentralized and secure alternative for remittances, enabling individuals to send funds to recipients in different countries quickly and at a lower cost. However, regulatory considerations, liquidity challenges, and exchange rate fluctuations are factors that need to be addressed for widespread adoption of blockchain-based cross-border payment solutions. Identity verification. Blockchain technology has the potential to revolutionize identity verification by providing a secure and decentralized way to verify and authenticate identities. Traditional identity verification processes often rely on centralized databases and intermediaries, raising concerns about privacy, security, and the risk of data breaches. Blockchain-based identity verification systems can offer individuals more control over their personal data and allow for selective sharing of information without compromising privacy. By storing identity information on a blockchain, individuals can maintain ownership and control over their data, granting access to specific pieces of information only when necessary. This can enhance security, reduce the risk of identity theft, and streamline processes that require identity verification, such as opening bank accounts or accessing online services. Governance and regulation. The adoption and regulation of blockchain and cryptocurrencies vary across countries, with ongoing discussions about how to effectively govern these technologies. Governments and regulatory authorities are working to develop frameworks that balance innovation and consumer protection. Some countries have embraced blockchain technology and cryptocurrencies, providing regulatory clarity and creating favorable environments for blockchain-based businesses. Others have taken a more cautious approach, implementing stricter regulations or focusing on potential risks and concerns, such as money laundering and market manipulation. The evolving nature of blockchain and cryptocurrency regulation reflects the need to strike a balance between fostering innovation and safeguarding against potential risks. Regulatory considerations include licensing requirements for cryptocurrency exchanges, anti-money laundering, AML, and Know Your Customer, KYC, regulations, tax implications, and investor protection measures. Effective governance and regulation can help promote trust, transparency, and responsible growth in the blockchain and cryptocurrency ecosystem, while also addressing potential challenges and risks associated with these technologies. Energy consumption. The mining process in some blockchain networks, such as Bitcoin, consumes significant amounts of energy, raising concerns about environmental impact. Proof of work, POW. Consensus mechanisms used in these networks require miners to solve complex mathematical problems, which demands substantial computational power and energy consumption. As the popularity and participation in blockchain networks grow, so does the energy consumption associated with mining activities. However, it's important to note that not all blockchain networks consume the same level of energy. Efforts are underway to explore more energy-efficient consensus mechanisms, such as proof of stake, POS, and other consensus algorithms that require less computational power and energy consumption. Additionally, initiatives are being developed to leverage renewable energy sources for mining operations, mitigating the environmental impact of blockchain technologies. Blockchain beyond cryptocurrency. Blockchain technology has applications beyond cryptocurrency, including in areas such as healthcare, supply chain management, voting systems, and intellectual property rights. The inherent features of blockchain, such as transparency, immutability, and decentralized governance, make it suitable for various industries and use cases. In healthcare, blockchain can enhance data interoperability, secure medical records, and streamline healthcare processes. In supply chain management, blockchain can provide end-to-end visibility, reduce counterfeiting, and enable efficient tracking of goods. Blockchain-based voting systems offer increased transparency, auditability, and trust in electoral processes. Moreover, blockchain can address challenges related to intellectual property rights by providing an immutable and timestamped record of creations and transactions. These examples highlight the potential of blockchain technology to revolutionize traditional systems and bring about efficiency, security, and accountability in various sectors beyond the realm of cryptocurrencies. Thanks for watching. Please like, share and subscribe, and comment below if you agree, or would like to add your thoughts.